Let me start with those basic of questions. What exactly is a zombie company, and how many of them are there out there?
First of all, to take a step back, what you need to think about is that over the past 10 or 15 years, global debt levels have skyrocketed. We've had very low interest rates. And for example, non-financial corporate debt around the world is now close to 100% of GDP. And that's more than double what it was a decade ago. So that's a very worrying backdrop. And so what we mean by zombie companies is a company that essentially has to borrow to keep going. They are highly leveraged, they're not growing very fast, their revenues are not up to par. And at the moment, they face a very difficult situation. You've got higher input costs, so your commodity prices are higher, wages are rising. At the same time, you don't earn enough revenue to cover all of these higher costs and your debt service. So if you have a ratio of revenues to interest costs that's 1 or less, if you can barely cover your debt service costs, we call you a zombie company. And it's a very good name. It's very evocative. And for how many? I mean, it's difficult to calculate, right? Because for a lot of firms that, for example, aren't publicly listed, the information might be less available. They might be smaller, non-public companies. But the Federal Reserve estimates that between 5 and 10% of U.S. firms fall into this category. I think it's also important to remember that this is not a static world. It's not once a zombie, always a zombie. Conditions change. And in fact, becoming a zombie company is a little bit cyclical in the sense that when times are good, maybe interest rates are low, growth is high, maybe you're not a zombie. But then, you know, bad things happen. Pandemics happen, shocks happen, interest rates go up. And a company that was formerly doing reasonably well might suddenly fall into the zombie category.
So you mentioned the overall debt load, which is true certainly in the United States, and not just in the United States, in part because interest rates were so low. There are some very, very successful, healthy companies that loaded up on debt because it was so cheap. And whenever we've talked about this risk in the last few years, they said, don't worry, as long as interest rates are low, we're fine. It looks like those days may be on their way out. We're going to have higher interest rates. So what kind of pressures does that put on these zombie companies?
Well, I think it's a good analogy, right? It's all fine until it's not. And so you've had a kind of a confluence of factors that have hit pretty much at the same time. You had a pandemic which hit growth. You had a commodity price shock. You have rising inflation. You have higher interest rates. And you also have firms whose business models, for example, have been entirely changed by the pandemic. I mean, amongst the list of zombie companies, you might find a company like WeWork, you know, a company that has been very successful, but at the same time, the pandemic has changed a lot of things for that company. Carnival Cruise Lines is another good example of a type of company who's now in the zombie category, or some of the meme stocks, you know, AMC or GameStop. So these are really household names. And I think that the difficulty is, at a point in time when you've got wages rising, when you have higher input costs, these firms may not be able to borrow as much as they need to borrow to keep afloat.
So do you tend to find zombie companies concentrate in certain sectors or in certain size corporations?
So I think it's fair to say that the sectors that are worst off in terms of percentage of zombie firms are probably in manufacturing and in retail. And retail, of course, is an industry that's undergoing secular change over the long term as we move to sort of more online, you know, less brick and mortar. I think there are underlying structural issues there in that sector in any case. But I think some of the companies that are hardest hit tend to be smaller firms. And if you think about a small company, they sort of inherently face greater credit risks than some of the larger, better established companies that have long-standing histories and track records in borrowing. They're, you know, familiar to investors. Smaller companies have a harder time accessing funds, especially when borrowing conditions are difficult. And with some of these companies having fallen on hard times during the pandemic, you know, there are estimates that suggest that in some cases as much as 25–30% of the small cap companies, especially if you include unlisted companies, could be falling into this sort of zombie trap.
I wonder, Sonja, about the larger effects on the economy. Obviously, we don't wish ill for any corporation, but there's going to be a lot of stress put on a lot of the companies you're describing right now. Insofar as that all gets sorted out, to use a euphemism perhaps, Is there some benefit for the economy in redeploying the capital they represent into things that might be more productive than their enterprises?
I think we might want to think about this in a short-term and a long-term context. So in the short term, it is very helpful for the economy to keep these companies afloat. And you could think of the example of Japan here, which has spent over $800 billion US since the pandemic hit to support its companies. So you avoid bankruptcy, you keep people employed, you keep these companies afloat. But there's a longer-term cost to be paid for that. Because when you think about it, money that's being spent to keep zombie companies afloat is money that could be more productively deployed elsewhere. You could put it into capital spending. You could put it into infrastructure. You could put it into new industries, new technologies, maybe in the ESG world or green technology that can really deliver a boost to productivity and growth. So it's kind of a foregone opportunity in that sense.
At the same time, for the reasons you described, and the example of Japan is a good one, it strikes me, there are political consequences of letting zombie companies go belly up.
Well, you know, the politics of these things are always difficult, right? I mean, one of the conclusions that you can come to is that if you have a high proportion of zombie companies, if you have companies that you're worried about keeping afloat, there's political pressure to keep that going. The more that borrowing costs rise, the more that interest rates rise, the harder time these companies will have keeping going. So if you're in a world where inflation is rising and you have central banks having to make a very difficult balance between controlling inflation and supporting growth, which can involve supporting some of these less profitable companies, you know, it's a rock and a hard place. You know, where do you draw the line?
I wonder, Sonja, if in fact the Fed could be held responsible for this many zombie companies. And maybe it's not with their intent, but it certainly was a consequence of extraordinarily low interest rates for a long time.
Well, I think ultimately, as arbiters of the price of money, you could hold the Fed responsible for everything, really. But certainly it was an inadvertent consequence of low interest rates. I mean, if you think of the many, many years when we had low and in some countries even negative interest rates, there were warnings sounded all the time. There are risks to financial stability. There are risks to long-term growth. It's going to stoke inflation. It's going to distort financial markets, distort asset valuations. And in fact, you can think of zombie companies as a type of distorted asset valuation, right? Because a company that cannot generate enough revenue to support its debt service and its running costs arguably is trading at an inflated valuation because it can continue to borrow at low rates. So you could sort of put it on the backs of central banks, but it's certainly an inadvertent consequence of something that had to be done to keep growth going during after the financial crisis.